So there's a storm coming in America. Today, we're spending $1 trillion a year to service the debt that America has accumulated over the years. That's roughly 20 to 25% of our total revenue that we take in. That's not sustainable because we're not paying down the debt. Matter of fact, we're adding to the debt every year. And at some point, tax rates are going to have to increase. And so our focus is, how do we protect your portfolio from those potentially future tax increases?
Hello, everybody, and welcome to the Sleep Well Financial Show. My name is Josh Nahosa, and I am an independent advisor representative for Swan DFW. And across from me is Hector Nahosa, who's a certified financial planner, which in the original Greek means the smartest looking and best intelligence person in America.
Well, obviously we got our metaphors mixed, but yeah, something like that.
Yeah. Hector has been in the industry since the mid-90s, so he's been in this for a long time. He knows everything there is to know about finances and more.
Well, not everything. I've seen a lot. I haven't seen everything, but I've seen a lot.
So we're talking about taxes today.
The great state of taxes, but also the taxes that you have to pay,
because I think that pertains to everybody. Nobody likes paying taxes, but at some point you're going to have to pay taxes.
That's right.
And in the intro, you said a storm is coming.
A storm is coming.
And we're going to talk about that storm right now. So how would you like to get into that?
Well, it's no big secret that America has done a very poor job in its fiscal responsibilities. We have a budget that hasn't been balanced since 2001, and we're adding billions of dollars to our debt every single year. And that debt just continues to increase. Somewhere down the road, people don't understand that historically we're at really low tax rates today, that even in the 70s, tax rates were in the 70%. Going back to the 40s, they were as high as 95, 96%. So there's a tax increase coming just to try to stop the bleeding here.
Yeah. I think a lot of people are always like, I'm paying too much in taxes. But if you really, really look at a graph, we're actually at historically low rates. Maybe not the lowest ever, because if you go back far enough, I mean, you're talking about originally, I think in America in the 1700s, the tax was like 2%.
Well, there was no federal income tax until the early 1900s. And then they said, okay, what? We're going to do it's going to be 1%, but only about 1% of Americans will pay it. And they'll pay 1% and will never increase that. And more people will never pay it. Wrong and wrong.
Yeah. But so here we are today. We have a 37% is the highest marginal tax rate in our country. And that is significantly lower than 70 and 90%.
Yes. But we've gotten used to 22 and 24. And but the challenge is that if something doesn't happen, and most people, I think, have that gut feeling that there's something wrong, and we need to fix it. And so, but the conclusion I've drawn is we can't individually fix the problems of America. We elect 535 people to do that, and they've not done a good job. So what we need to focus on is how do we protect our portfolios from the storm that's coming, from the potentially doubling of taxes in the future. We can't keep that from coming, but we can protect our portfolios.
Yeah. So our next handful of episodes is going to be all about different ways and strategies to do that, and just all about taxes for the next at least few episodes, I think, because it's top of mind for a lot of people, I think.
It is. And so, kind of like we said, we've got two different parts. We have the annual budget that we haven't balanced in a while. And then we have the debt that we keep refinancing with 1 and 2 and 3 year notes. What should have happened during COVID, when we were down at 1% and 2% interest rates for bonds and U.S. bonds and treasuries, is we should have taken as much debt as we could and refinanced it at 1 or 2%. But we didn't. And so here we are. Now it's 4.5 or 5. And if that keeps going up, well, then the debt servicing keeps going up. And we went from 34 to 38 trillion really fast. And the number that scares people that do this like full time is 53 trillion. At 53 trillion, all of a sudden we've got way more money the money coming in to service a debt. And that leaves very little money for everything else that we need to do: Medicare, Social Security, defense. So we need to do something. Our politicians have kicked the can down the road, and eventually somebody's going to have to pay the piper, and usually it's middle-class America, because that's where all the money is.
Yeah. And so it's, kind of the onus is on yourself, to protect your assets from that. Because at some point, likely, taxes are going to have to go up. Something is going to have to change. And we'll talk about that more in future episodes. But the onus is kind of on you to protect yourself from this.
Right. That's exactly right. And there's some certain things you can do to start. There is no way of not paying the taxes. What we're going to suggest over the next few episodes is pay the taxes now, while taxes are historically low, to keep you from paying double or triple the tax, or some amount way more than what it is today down the road. And nobody likes to pay taxes when they don't need to, but I think we're gonna make an argument that it makes more sense to do that now. The only person that wouldn't want to do that right now would be a person that says, no, for sure tax rates are going to go lower. If you think tax rates are going to go lower, then I wouldn't do anything and just wait for taxes to go lower. But the math suggests something way different.
Yeah. So that's going to be what we talk about the next handful of episodes. We hope that you'll stick around and keep an eye on our page, wherever it is you're watching or listening, whether that's Facebook, YouTube, Spotify. Give us a like, give us a share this with a friend, share this with a child, a parent, whoever.
Even people aren't your friends. And this is all good news, believe it or not, because I feel like we've gotten like into a really down, somber music coming on. People, this is good news because we have time. We don't know how much time. We could have 5 years or 10 years. We have a certain amount of time to start repositioning portfolios in a way that won't get hurt by a doubling or worse of tax rates. So it's hopeful. There's things you can do. We told a story the other night of Wile E. Coyote trying to get rid of the Roadrunner, and he had an idea. He was going to build a bomb that's made by Acme, and so he went into a shed that's made by Acme, and he started building the bomb. And he was so intense in doing that he failed to recognize that the Roadrunner had moved that shed onto railroad tracks. And he kept working, the coyote kept working until he heard a noise. And then he looked out the window and there was a train coming. And when there's a train coming and you're on the tracks, most of us would say, do something. And he did something. He pulled down the shade. And that's what many Americans have done, is pull down the shade. We don't want to think about that. It makes us feel bad. And pulling down the shade didn't help the road. It didn't help the coyote. He got, the train crashed and he never dies, but it was in really bad shape. So we're saying, don't pull down the shade. Let's figure out some strategies that will help position your portfolio for that oncoming storm.
Yeah. So our next few episodes are going to be all about ways to do that. And if you would like to talk to us about how to do that for you, we have a couple of different ways that you can contact us. The first way is via phone number. That is 888-792-6339. We also have an email address, and that is info@swandfw.net. Both of those will be in the description wherever it is you are watching or listening.
Thank you for watching us. And like Josh said, give us a like, share this with somebody, but more importantly, come back for episode 2 of Sleep Well Financial
Show.
We'll
catch
podcast.
We'll catch you on the next one. The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.